Hello everybody. Welcome to uh, our YouTube channel, brought to you by Taxation Law Uganda, where we look a little bit more detail into employment income, uh, particularly the computational aspects. So we shall be combining the law, that is mostly Section 19, together with our computational skills in order to come up with the tax computations that are quite vital in this particular topic of employment income. My name is Norman Enyang, and I'll once again be taking you through our session, which is particularly concerned with employment income, as I mentioned there. So we have a question that we shall be doing together, a fairly detailed question, this one, so it should be able to bring together our bits and pieces of knowledge into one concrete tax computation there. So as usual, I advise students to look at the requirement first, then we can come and look through the scenario as we work out the bits and pieces. So the question requires us to compute in part A the tax payable by Ambokile for the period ending 31st December. So we can then get back to the question and read it. Now, as a student, the best thing that you can do to yourself is to read the question in bits as you solve it bit by bit. So that then means the worst thing you can do to yourself is to try and look at it as a whole. Definitely there you'll be making life harder for yourself, and definitely harder for you to score marks, and of course that makes it easier for you to fail. So the best advice is to look at the question in bits and pieces, as we are going to do. So off we go. The question reads: Ambokile is a certified public accountant of Tanzania, working as an expatriate finance director at Total Uganda Limited. In January 2018, as part of her entitlements, she is availed with a vehicle for use on both private and employment duties. That's an aspect of a motor vehicle benefit coming in there. In fact, she even goes with the vehicle to Arusha, that's in Tanzania, on weekends and during leave. The vehicle is a V8 Land Cruiser purchased from Toyota Uganda in 2017 at a cost of 480 million. Here is another vital information. The vehicle was first assigned to the managing director. So already we can see that Ambokile got the vehicle after 1 year and therefore on a depreciated value. The next sentence: the company charges her a monthly nominal fee of 2 million shillings for the use of the motor vehicle. So we shall have that computation. So you can see that we have enough information to begin with, because they have given us enough information on the motor vehicle benefit. The next bit I see is talking about a cash payment. That should be a salary. So we can work out using what we just shared. We can be able to work out the motor vehicle benefit. So there we go. We can start off our solution by having a working there on the motor vehicle benefit. So what does it? Which section are we referring to? So the motor vehicle benefit. This is a benefit. So that benefit is in section 19, subsection 3. I encourage everybody watching this video to have a copy of the latest Income Tax Act there. So section 19, subsection 3 helps us to determine the benefit, and this refers us to the fifth schedule. And if you go to the fifth schedule, you'll find evaluation for motor vehicle benefits under paragraph 3. So a bit of a formula there, which I can be able to share. So what does it involve? What does paragraph 3 of the fifth schedule say? It says, where a benefit provided by an employer to an employee, here we clearly see a benefit provided by Total to an employee called Ambokili. So where that benefit consists of the use or availability for use of a motor vehicle, wholly or partly, Ambokili is using it wholly, the value of the benefit is calculated according to the formula that is of 20% times A times B over C. So when you look at this fraction, it looks a bit detailed, but it's not as complex. So what is the value of A? A is the market value of the motor vehicle at the time when it was first provided for private use of the employee, depreciated on a reducing balance at a rate of 35%. So we can clearly see that that value of A shall very easily be computed as the original value of the vehicle, which we saw very easily as clearly in the question as 480 million. That 480 million, what it was depreciated by 1 year. 1 year at 35% will definitely lead us there to 480 million minus 35% of 480 million. So what are we saying here? What we are simply saying is that that vehicle was actually given to Ambokile after it had lost value. Depreciation is the fall in value of a fixed asset. So if we are depreciating it at 35% on a reducing balance, it means after 1 year, the value of the vehicle would have fallen there by 35%. So once we reduce it by 35%, we shall have the value of the vehicle as 312 million. So that's a very decent start for us. We have the value of A. How about the value of B and C? B over C is a fraction of the proportion of the number of days in a year that the motor vehicle is available for private use. And here clearly we were told that Ambokile uses it even in during weekends and even when she's on leave. So the fraction B over C will very easily turn out to be 365 out of 365. What someone would say is one whole number. So there isn't so much. So you can see that we're moving to the end of the equation. D is any payment made by the employee for the benefit. So in our question, we were also told that Ambokile was paying a nominal amount, a nominal fee of 2 million per month, a monthly nominal fee of 2 million there for using the vehicle. So that then means the annual amount contributed by Ambokile would be 2 million times the 12 months that we have in a year, and that leads us to 24 million. So from here, you can see that we have everything in the equation. So the meaning of that is we can now have the value of the benefit. So putting it back into our equation where the value of the benefit was, we can open brackets, 20% times A has now become 312 million, and then that should be multiplied by the fraction B over C, which is one whole number, and then all this we shall less the annual contribution there by the Tanzanian expatriate Ambokile, which will lead us to a fee of 38,400,000. So there we are, off to a very wonderful start there. We have managed to compute the motor vehicle benefit there. If you may allow me to indicate here, we definitely have a number of benefits. Sorry, I have to do the typing and the talking there. So that is the value of the motor vehicle benefit. We then move to the second benefit. I would encourage each of you to have a copy of this question. The second benefit, this is actually, sorry, that's not a benefit, but the second source of income is the monthly cash payment. So that monthly cash payment can be interpreted under section 19(1)(a) as a salary. So that one, very little work for us to do there. We have salary, no computation required whatsoever. It's a figure that we just need to transplant there, but of course that is given rise to by section 19(1) there, 19(1)(a). So that is our salary, and that salary is 24 million a month. So the annual value of that would be 24 million times 12 million, which ends here as 288 million. So we now have the value of the salary. Next is the travel allowance for Ambokile's spouse of 12 million per month, 12 million per annum there. Let me just confirm. So we have a travel allowance of 12 million. So we can include that as well. Travel allowance. This is also under section 19(1)(a) there. Section 19(1)(a). So that travel allowance is taxable. The travel allowance is taxable according to section 19(1)(a), and just like the previous section, it has a direct value of 12 million. So not much effort required in computing that. What then follows? We have the next benefit. Ambokile is provided with a residential house in Nakasero. The value of the residential house in Nakasero. Now, this benefit is looked at under paragraph 10 of the 5th schedule. Paragraph 10 of the 5th schedule states that where a benefit provided by an employer to an employee consists of the provision of accommodation or housing, just like it is in this case, other than where section 19(1)(a) or C applies, the value of the benefit is the lesser of, so we have two values coming in there, the market rent of the accommodation or housing reduced by any payment made by the employee there. So what they have told us about this house is part of the company houses. As we do further reading there, if we can move together, this house is part of the company houses reserved for senior managers and expatriates. No problem with that. The house has an annual market rate of 60 million, but she's making a monthly contribution of 1.5 million per month. So they're telling us the first option is the lesser of the market rent of the accommodation reduced by any payments. So we can work out that, because in the end it will be the lesser of that and 15% of employment income, including the amount referred to in this initial computation. So that one will definitely come last. But we can first compute the housing allowance, because we shall need the calculation in part A, so we can't do without part A there in our calculation. We cannot do without finding the market rent less any payment made. So if that is the case, then we can proceed. We can surely be able to proceed, and then be able to look at the first part of the computation of the housing allowance. So the market value is 60 million. The market value there is 60 million per year, less the contribution by the employee, which is 1,500,000. Once again, multiplied by 12. That leads us to 60 million less 18 million, which is 42 million there. Our momentum getting on there. So we have the first value, and then part B. Remember, it's the lesser of. We shall compare it with 15% of the employment income, including the 42 million here. So let's proceed. Let's proceed. The next, she was reimbursed with 5 million being the cost of passage to Uganda when taking up the job. She was reimbursed with 5 million. So you'll also notice by looking at our Income Tax Act Section 19, particularly subsection 2A, you will know that this reimbursement is exempt. So we can state that as exempt. That reimbursement is exempt. Remember, you seeing that income as exempt and you not stating may as well the examiner may think that you just didn't look at it. So looking at it and keeping quiet because it's exempt might not be enough to earn you due credit there. So the reimbursed cost of passage, this one is exempt, and particularly our section there will be section 19, subsection 2b there is our basis for taking that income as exempt. Let's continue. The fifth information we are given is that the company paid her 15 million in 2018 being discharge of her medical bills. Being discharged. The reimbursed cost of passage is exempt under section 19(2)(a). And then when we look at the medical bills, there, so we can say discharge for medical bills. That one is exempt under the next section there. Sorry for that. So discharge of medical bills is exempt there under the following under 19, the same section actually, but this is 19(2)(b), 19(2)(b) there being our basis for that exemption. So we then continue. The employer made a contribution of 3 million monthly to her retirement scheme, NSSF. So NSSF, we know that this one is also exempt. NSSF is surely exempt. and the basis for that is 19 2G. As I said, when you look at the law, this will make a lot of sense if you look at that subsection. We then continue. The company grants benefits to senior employees, I know of which surely Ambokile is among, including her, in the form of wines worth 50 million monthly for the whole year, hence 12 bottles for the entire year. So if you look at section 19, subsection 2F, this kind of income is taxable. This one is surely taxable under section 19.2F. So what do we have here for the wines? So given that this benefit is actually above the threshold of 10,000, then the whole of it becomes taxable. So if you will read section 19.2F, you'll be able to realize that if it is above 10,000, then the whole benefit is taxable there. So what then do we have as the value of this benefit of wine? The value of this benefit of wine will then be the 50,000 times the number of months that make up our year there. So this particular one leading us to 600,000. The next is that they're telling us that the company, the next one is about a housekeeper. We can go back to our question there. Sorry, I have a printed copy here that I've been making reference, but we can go through the question still together as we continue. The company pays her housekeeper 400,000 per month. The company pays her housekeeper 400,000 per month. So we can also include that in our calculation there. So if the company pays Ambokile's housekeeper 400,000 per month, what is the value of that benefit, and what is the section? If we look at section 19 subsection 3, where benefits, which will direct us to the 5th schedule, and particularly paragraph 4, it says, where the benefit provided by an employer to an employee consists of a housekeeper, a chauffeur, or gardener, the value of the benefit is the total employment income paid to the domestic assistant in respect of services rendered to the employee, reduced by any payment made by the employee. So we have no proof that Ambokile made any payment. Let's just read that again. So it is also clear that the company actually paid Ambokile's housekeeper. So what then is the value of that benefit? Is simply 400,000 once again to be multiplied by the 12 months in a year, which will lead us there to 4,800,000. So we are progressing. We are really progressing. Next, the company runs a separate pension scheme. These ones are exempt under 19.2G. The value there 200 million, but we want to make up our calculation there. So pension scheme, we can confidently say that this is exempt, and the basis for that is section 19 subsection 2 G there. So that benefit is exempt. We then continue. The next one talks of a beneficial loan. This one is surely a beneficial loan. The company has a policy of encouraging directors to acquire loans at lower rates to enable them acquire property. So as soon as you see the word lower rate or a beneficial loan or whatever way it's stated, it is giving the employee an advantage compared to the market. So in this case, the rate is 6%. Sorry, let me get back to the question here so that we can read together as we move towards the end. The company has a policy of encouraging directors to acquire loans at a lower rate to enable them acquire property. She was thus given 250 million at an interest rate of 6% per annum, which she fully paid back by the end of 2018. So the value of this beneficial loan is the market value, the bank, the rate from Bank of Uganda, the lending rate minus the interest rate which they are giving her. So that interest which she is saving, that difference is now the taxable benefit. So what then forms our calculation? Now, because out of the, if did we see the Bank of Uganda rate somewhere? Yes, it's the last bit of the question. Assume the following. Bank of Uganda lending rate is 13%. So clearly, we are easily able to compute there the value of the beneficial loan. So the value of the beneficial loan, what is it, and what is our section there? So the beneficial loan is also looked at under section 19, subsection 3 there. The value of the beneficial loan. What is that value? The value of the beneficial loan now is the difference. By the way, you can do it in two ways, but I think it may just be cumbersome for you to first of all work out what would have been the market rate of interest and then subtract the interest that Ambokile is paying. I think that would be double work. So the best thing that you can do to yourself as a student is for you to say 13%. You look at the percentage difference, that's the market rate minus what Ambokile is paying, and then be able to multiply that by the value of the loan. It's a little bit shorter because we are looking at the benefit there. So that will mean we have to compute 7% of 250 million. The value of that loan, therefore, being 17,500,000. There for us, I think we are really progressing. The next, what then is our next benefit, and is it taxable or is it exempt? Next, Ambokile, part 11. Ambokile has two children who study at Kampala International School, and the company pays for them fees at 4 million per child per term. So if they say 4 million per child per term, and they're telling us that KIS has 3 terms in a year, that is even making life very, very, very easy for us there. So we know that we have 3 terms for 2 children. So if we wanted to look at the value of that benefit, it would just be quite a straightforward arithmetic operation for us there. So let's look at it there. What's the value of the school fees? This is computed in accordance with section 19, subsection 3, that's for sure, this being a benefit. And then paragraph 11, if you look at it critically, paragraph 11 of the fifth schedule. It's important for us to know the section of the law that we are referring to, or which paragraph of the of the schedule. So paragraph 11 will lead us now to having this computation. And from paragraph 11, we realize that the value of any benefit provided by an employer to an employee, which is not covered in any of the clauses above, will then be the market value of the benefits. I would like to compute this before I even finish reading that subparagraph. So the market value of this will now be the 4 million for each of the two children, so times 2 times the number of terms in a year there in that particular international school, which is actually 24 million there in the year. So that is the value of the benefit. So we can complete reading. That value is the market value of the benefit at the time the benefit is offered and is reduced by any payment made by the employee to the benefit. So here we are not told any amount that Ambokile contributed. If she did, then they would have told us. So unlike the motor vehicle, we don't have anything to deduct here. So what's the meaning of that? We have the value of the school fees benefit, which will then find its way to our calculation for the tax payable by Ambokile. So we can rush back to the question as we move towards the end. Next, part 12. The company also pays for her club membership at Kabira Club at 1.3 million per annum. What is with the club membership at Kabira Club? Is it taxable? Is it exempt? If exempt or taxable, which part of section 19 are we focusing on? Which part of section 19 are we focusing on? We can get back quickly to our calculation there. And we are calculating there the club membership. So this one falls under section 19, 1A, section 19, 1A there being our basis of taxing this benefit. So under this section, it will take the direct value. So the value, we don't need to do any computation. After all, we are already given as 1,300,000 a year as we draw to the very end of the calculation of as we draw nearer to the end of the calculation of these benefits. Now, part 13 tells us because of insecurity in Kampala, the company pays for her security at her residence for 600,000 per month. That one is quite important because security is also exempt. But unlike all the other previous exemptions, which we look at particularly under section 19 subsection 2, this one is not given rise to that. And there was a practice note issued in 2001 to that effect. I don't know if I can find that subsection of the practice note, and it talks of valuation of benefits. Here it is. Provision of security guards. It was issued in November 2001, this particular practice note, and it took effect on 1st July 2001. There, the practice note coming to make some clarification there. So an employer, it states, An employer's provision of security guards is not classified as a taxable benefit under the fifth schedule. So that then draws emphasis to the fact that the benefit of the security guard is exempt. We can make it comprehensive by indicating it here. So this one is exempt, and where do we get that basis? Is the practice note of 2001 there. So that one is exempt. As we draw nearer to the end of this computation, what are we left with? She also received a medical allowance of 6 million per month. Now, the medical allowance of 6 million per month, kindly note the very strong difference between getting a reimbursement and an allowance. If you get an allowance, that one is taxable. If you get a reimbursement, that one is not taxable. I hope we are all aware of that. So if that is the case, the medical allowance given to us as 6 million will definitely find its way into our tax computation. So what is the implication of that? The medical allowance. So what then will follow? The medical allowance was 6 million. So according to section 19(1)(a), this one will definitely be taxable. So we can indicate that as a taxable benefit as it is. Sorry, there, section 19(1)(a). So that is the taxable benefit whose value is exactly the nominal value that we are given there, which is 6 million. There, that will find its way to our tax computation. And then the next piece of information, we are told that is part 15 now. She will also receive 48 million Uganda shillings from Total to change express terms of her contract to remove the clause on automatic renewal of her contract after 31st December. So if we look at this, the amount she'll receive under 48 million, this is also provided for. This is provided for under 19F, 19(1)(f), sorry, and of course that makes it a taxable benefit. And 19(1)(f) states that any amount derived as consideration for the employee's agreement to any conditions of employment. So it may not only be in this kind of condition. So any amount derived as consideration for the employee's agreement to any conditions of employment or to any changes in his or her condition of employment. So that is what is our basis for saying the 48 million is taxable. Of course, that's one of the reasons I've been emphasizing. You need your copy of the Income Tax Act to be able to make the best of this particular question. So if we look at what should hopefully be our last or second last computation, the change in terms of contract. That's how we shall term that. So this one is taxable and our basis for that is 19 1 19 19 1f there, 19 1f there. So what is the value? What is the value of that? What is the value of that benefit? We already given the value. We already given the value of 48 million. So the value of the benefit will then be the 48 million we are given there. And then what is our very last piece of information? Let's look at it together. Is the fact that Ambokile, being the finance director, made 10 field visits in the year and spent a total of 19 nights. He would be entitled to per diem of 180,000 per day and transport allowance of the amount equivalent to the amount used on fuel, which was 3 million. So that is a refund. That is more of a refund, and of course we know that all allowances are given which do not exceed the cost actually or likely to be incurred, this being in the duty of employment, are exempt. So that particular expense is in the category of what we can term as per diem. That per diem is most definitely exempt. And what is our basis for saying it is exempt? This is under 19 subsection 2 D there. So per diem is exempt under 19 subsection 2D. So that being the very last piece of information we were given, it then means we can go ahead. There and make the computation. We can go ahead there and make the computation for the tax payable, which was our requirement of Part A, computation for the tax payable by the expatriate. Tax payable by the expatriate. Now, you may also notice that we are not yet done with the housing allowance. But remember, before we get the value of the housing allowance, which will be the lesser of the two values, first is the market value of accommodation less any payment, and 15% of the employment income. So we are tasked to get the total computation for the employment income. After that, we shall get 15% of that value. If it is lower than the housing benefit that we computed, then we shall go with that. If it is higher than the housing allowance, then we shall abandon it and move with the figure that we had. So you'll just allow me to bring in the totals there. You'll just kindly let me to bring in the totals there, because what totals did we have there? Maybe we can write them quickly. I'm a bit worried. The recording is it's getting a bit long. So the motor vehicle benefit was 38,400,000. The salary we got as 288 million. Then I think there was the travel allowance. You'll help me to indicate the sections in your summarized computation. Our travel allowance was 12 million, the one for the spouse. The housing, of course, that is not yet done. We still have to get 15% of the employment income. But by getting the market value less the contribution by the employee, we came up with a figure of 42 million. The value of wine being above the trivial benefit there. The value of wine gave us a figure of 600,000. The value of the housekeeper, Mbukile not making any benefit, any contribution there, at 400,000 per month. We ended with 4,800,000. There was a beneficial loan, beneficial in the sense that the interest being paid was less than the market value. So the beneficial loan, the value was 17,500,000. That interest saving there by Mbokile. And then the school fees for the two kids, there being 24 million. And then we also remember that we had a club membership which was given to us as an annual figure. We already indicated that in our detailed calculation was 1,300,000. And then the medical allowance, remember it wasn't a reimbursement. The medical allowance there was 6 million, which was taxable. That is what we have. And then lastly, we also had a provision for the change of terms of the contract there, if I may state it like that, which we looked at under section 19(1)(f), and that one came to 48 million, was a block figure given there. So if we look at the total, we came to a figure of 482,600,000. You'll add them individually and compare them to that. But the contest is not yet done. Remember, housing allowance is the lower of the two values we are given, 15% of employment income, and then the value of the property less than a contribution by the employee. So 15% of the, by the way, this total of 482 million is what we can now refer to as the employment income. So we are still, as I said, interested in getting 15% of the employment income. So 15% of the employment income will now lead us to 15% there. 15% of 482,600,000, and this from my calculation will give us 72,390,000. So this, you can see, is higher than the previous. So that means we shall take the least, and so we shall go with the 42 million that we came up with there. So in conclusion, we can now do the computation of the tax payable. Mbokile, I must emphasize, should be a resident taxpayer, given all these criteria that she's in employment in Uganda. So if she's resident, Then we use the rates for resident, individual taxpayer, and those rates are stipulated. Again, you can look at part 1. You can look at part 1 there of the third schedule, quite stipulated clearly. So from those rates, we know that the first 2,820,000 is taxed at a band of 0%. I encourage you to look at these rates. With time, you can even have them off head. They're actually only 5 bands. So the first 2,820,000 is taxed at 0%. Then the next amount by which it exits the next bracket, let's say, is 4,020,000 less the previous limit there of 2,820,000. This one is taxed at an additional rate of 10%, which leads us to a figure of 120,000 in that tax band. The next band ranges from 4,920,000 as the upper limit, and of course the lower limit will be 4,020,000, which of course was the upper limit in the previous bracket there. And so that would then lead us to a tax rate of 20%. And by my computation, this gives us a figure of 180,000. The next band is 120 million as the upper limit. Of course, income tax here being a progressive tax, minus what was the upper limit in the previous bracket is now our lower limit, 4,920,000, and the rate is 30%. And that, again, from my calculation, is 34 million. You can obviously do yours as well and compare 524,000. And then the very last bracket is the 40%, the 40% ban. So we get the total figure now, 482,600,000 minus 120 million, which will most certainly be taxed at 40%, and that will lead us to 145,040,000 there. So the tax payable by Ambokile will now be the first bracket had 0 plus 120,000, again plus 180,000 plus 34,524,000 plus 145,040,000, which will lead us to a total of 179,864,000. And so that is the tax payable by Ambokile for the year ended December 2018. So you can clearly see it has taken quite a lot of our time, but of course that is partly because I've been explaining and also typing. But you may agree with me, the question is not as difficult. Once again, the best thing that you can do to yourself is to read the question bit by bit, make an interpretation. Don't try to read the whole question at a go. Getting 1 or 2 allowances wrong it might not be catastrophic, But what is catastrophic is for you to be overwhelmed by the question, but also you realize if you move bit by bit, small bit by small bit, statement by statement, and you interpret them step by step, you'll definitely increase your chances of passing quite exponentially there. So I wish you the very best in your preparations with employment income. Feel free to make comments, make suggestions, and we shall definitely get back to you. For those who don't have a soft copy of the, who don't have a copy of the question, I can always share it with you. But if you like this video, as always, feel free to click the subscribe button there, and also feel free to suggest any topics on tax that may be bothering you, that you think we could be of quite some help. So until the next time we meet, thank you for listening and all the best.